Six of the world's most powerful central banks issued a coordinated statement on March 19, 2023, announcing they would increase dollar liquidity operations from weekly to daily, which marked the most aggressive intervention since the COVID-19 pandemic. Hours earlier, Credit Suisse had been rescued in an emergency takeover, and what the Basel Committee later described as the most significant system-wide banking stress since the Great Financial Crisis was already underway. Financial outlets covered the swap line announcement, but it got completely buried under the headlines everyone was actually reading: bank collapses and forced mergers happening in real time. 11 days nearly broke the global banking system, and this is the story of the emergency coordination that stopped it. Understanding why six central banks felt compelled to act in perfect coordination requires understanding just how fast the banking system unraveled in March 2023. Silvergate Bank announced voluntary liquidation on March 8th and 9th, a crypto-focused institution shutting itself down. That same day, Silicon Valley Bank disclosed a $1.8 billion loss on securities sales and announced a $2.25 billion capital raise, which sent the stock plummeting 60% in a single trading session. What came next had never happened before. The largest single-day bank run in American history unfolded on March 9th, when customers withdrew $42 billion in deposits primarily through mobile banking apps in just one day. By the time the sun set, Silicon Valley Bank carried a negative cash balance of $958 million, which meant the bank was insolvent. California regulators closed Silicon Valley Bank at 8 in the morning Pacific time on March 10th, and with $209 billion in assets and $175 billion in deposits, where 88% sat uninsured, it became the second largest bank. Failure in U.S. history, $20 billion. That's what the FDIC estimated it would cost the Deposit Insurance Fund. The contagion was just getting started. New York regulators closed Signature Bank within 53 hours of SVB's collapse, wiping out $110.4 billion in assets. That same evening, on March 12th, the Federal Reserve, FDIC, and Treasury announced extraordinary measures that included making all depositors at both banks whole by invoking the systemic risk exception, and they created an entirely new facility called the Bank Term Funding Program, backed by $25 billion in Treasury support. These weren't ordinary bank failures where institutions gradually deteriorated over months or years, but rather perfectly stable-looking banks brought down in hours by the speed of modern digital banking. And that's when the crisis jumped across the Atlantic. First Republic Bank saw its stock collapse 70% despite announcing $70 billion in available liquidity, but the real shockwave came from Switzerland. Credit Suisse, one of the 30 globally systemically important banks, watched its stock plunge 24 to 30% after Saudi National Bank's chairman publicly refused to provide more capital. And the hemorrhaging had already been severe, with $147 billion in deposits lost in just the fourth quarter of 2022. 50 billion Swiss francs, which equals about $53.7 billion, got drawn from Swiss National Bank emergency facilities by Credit Suisse on March 15th. The same day brought an unprecedented move when 11 of America's largest banks deposited $30 billion into First Republic, with JP Morgan, Bank of America, Citi, and Wells Fargo each contributing $5 billion. Banks don't coordinate rescues like this unless genuine terror drives them. Sunday evening, March 19, 2023, at 5 p.m. Eastern Time, Swiss authorities announced that UBS would acquire Credit Suisse for 3 billion Swiss francs, which came to about $3.2 billion and represented roughly 1% of Credit Suisse's all-time high valuation. The Swiss government guaranteed 9 billion francs in potential losses, while the Swiss National Bank pledged up to 200 billion francs in liquidity support, and 16 billion francs worth of additional Tier 1 bonds got wiped out entirely. A 167-year-old institution vanished. Six central banks issued identical statements hours later at exactly the same moment: the Federal Reserve, the European Central Bank, the Bank of England, the Bank of Japan, the Swiss National Bank, and the Bank of Canada. The statement read, "To improve the swap line's effectiveness in providing US dollar funding, the central banks currently offering US dollar operations have agreed to increase the frequency of 7-day maturity operations from weekly to daily. Operations would begin Monday morning on March 20th and continue at least through the end of April. Most people who aren't banking experts have no idea what a dollar swap line actually is or why it matters. So here's the reality that doesn't get explained enough. Non-U.S. banks held nearly $18 trillion in dollar liabilities by 2024, which exceeds 60% of U.S. GDP. And these foreign institutions need dollars to operate but can't access them without limits. Swap lines work through a simple mechanism where the Federal Reserve lends dollars to a foreign central bank like the European Central Bank, which provides euros as collateral, and then the ECB lends those dollars to European banks that desperately need them. Everything reverses when it's over. The Fed's risk stays limited to the foreign central bank itself, making it extremely low, but without these swap lines, foreign banks might dump US Treasury holdings in fire sales that would raise US government borrowing costs and amplify market stress. Research published by the Dallas Fed in September 2025 concluded that swap lines eliminate the possibility of pure self-fulfilling dollar bank runs because their mere existence prevents panic, even when they never get used. That's exactly what happened in March 2023. Central banks had coordinated before, with swap line usage peaking at over $580 billion during the 2008 financial crisis and hitting $449 billion during the COVID-19 response in 2020. March 2023 was different though. Swap lines activated within 9 days of Silicon Valley Bank's failure, and the move from weekly to daily operations got announced just hours after the Credit Suisse rescue, deployed before severe dollar shortages actually materialized as a precautionary measure. Bloomberg reported on March 20th that global central banks witnessed no dash for dollars after the announcement, with the Swiss National Bank awarding only $101 million in its first auction, while the Bank of England and Bank of Japan received no bids at all. Minimal actual usage made perfect sense because that was exactly the point. Yale's program on financial stability explained it perfectly when they wrote that central banks often activate swaps on a precautionary basis to calm markets, and activation doesn't imply that a central bank is already borrowing under the swap line. The message came through clearly: if you need dollars, they're available, unlimited, daily, so don't panic. Timing explains why this never became the headline story. The swap line announcement arrived the same day as the Credit Suisse UBS merger, a story involving a $3.2 billion forced takeover of a 167-year-old institution, $16 billion in wiped-out bonds, and Swiss emergency powers bypassing shareholder votes entirely. Bloomberg, Axios, and the Financial Times absolutely covered the swap line story, but it got positioned as central banks strengthening defenses rather than breaking news, and showed up as supporting context within the larger banking crisis narrative. The technical nature created problems too, since a coordinated enhancement of standing dollar liquidity swap line frequency doesn't generate the same clicks as Credit Suisse collapses written in all caps. But make no mistake, people who understand banking knew exactly what it meant. Nouriel Roubini, the economist famously called Dr. Doom for predicting the 2008 crisis, told Fortune and Bloomberg that we faced a fundamental trilemma where we cannot achieve price stability, maintain economic growth, and have financial stability at the same time, which means eventually we'll have an economic and financial crash. Mohamed El-Erian, former PIMCO CEO, expressed deeper concerns about central bank credibility when he said, "I am terrified that if central banks don't own their mistakes, if central banks don't learn from their mistakes, and are public about this process, people are going to say you're not accountable enough." Danielle DiMartino Booth offered perhaps the most vivid description on Twitter when she wrote, "A patient is having cardiac arrest. You can see the paddles to revive him, but you can't reach the paddles. These swap lines hand you the paddles." Not everyone leaned pessimistic though, and Forstenbeck provided a counterpoint by saying the global banking system is not about to collapse, noting that overall the banking system is significantly stronger than it was in 2008, and authorities are much better prepared to address distress early on. The enhanced daily swap operations continued through April 2023 as planned, before gradually returning to weekly operations as stress subsided. Peak usage of the Bank Term Funding Program, that emergency facility created during the crisis, reached $161.5 billion in outstanding loans by January 2024 before the Fed ended it. First, Republic Bank ultimately failed on May 1st with $229 billion in assets, making it the largest US bank failure in history when measured by total assets. But the coordinated central bank action achieved its goal by containing the contagion. The standing swap line arrangements remain fully in place today, available for immediate activation whenever needed. Here's why this matters for what's coming. The Federal Reserve ended quantitative tightening entirely by late 2025, leaving its balance sheet at $6.7 trillion, down 22% from its peak, but still historically massive at 22% of GDP. The European Central Bank's balance sheet dropped 20% from its peak to 6.32 trillion euros. Central banks began cutting interest rates throughout 2024 and into 2025 as inflation moderated, with the Fed reducing rates by 75 basis points between September and December 2024, and the ECB cutting its deposit rate from 4% to 3.25%. But here's where things get complicated. Different economies are experiencing different inflation trajectories, creating policy divergence. The Bank of Japan is hiking rates to 0.75% by late 2025, while Western central banks cut, and Morgan Stanley projects the ECB deposit rate will reach 1.5% by mid-2026. 3 FOMC voting members dissented at the Federal Reserve's December 2025 meeting, the highest dissent count since 2019, which signals serious internal divisions about the rate path ahead. The Brookings Institution raised a provocative question in May 2025 when they asked what would happen if some future Fed leadership declined to extend its credit through central bank swaps. They proposed an alternative where 14 major central banks with substantial dollar holdings agree to lend to each other, similar to the Chiang Mai initiative in Asia, though they acknowledged this would still require Fed coordination. The concern carries weight because several vulnerabilities are growing. Non-bank financial institutions like hedge funds, private equity, and mortgage REITs pose growing systemic risks, which is why the Fed's 2025 stress tests specifically examined banking system resilience against NBFI stress. Private credit grew to $1.34 trillion in the US and roughly $2 trillion globally by 2024, while increasing political uncertainty about Fed independence could affect future swap line willingness, and geopolitical fragmentation may complicate central bank coordination in ways that weren't factors in 2023. The March 2023 coordinated response established precedents that matter for future crises. Speed of activation came first, with daily operations announced within 9 days of SVB's failure, demonstrating that standing facilities enable rapid response without negotiating new arrangements during a crisis. Precautionary deployment followed, where action got taken before severe dollar shortages materialized rather than after. And as Yale's analysis noted, it doesn't necessarily mean that severe stresses already exist. Signaling power proved real when the mere existence of coordinated action calmed markets, confirmed by Dallas Fed research showing that swap lines can prevent runs even without actual activation. Scope preservation rounded it out when all 6 central banks acted simultaneously, demonstrating that international coordination mechanisms remain functional despite divergent domestic priorities. The Basel Committee on Banking Supervision reached a conclusion in their October 2023 assessment, stating that the banking turmoil that started in March 2023 was the most significant system-wide banking stress since the Great Financial Crisis in terms of scale and scope. Failures totaling over $900 billion in assets hit the global banking system in 11 days, with 4 institutions collapsing or getting rescued through forced mergers, and 6 central banks coordinating an unprecedented enhancement of dollar liquidity facilities to prevent complete contagion. The swap lines worked, markets stabilized, and the panic subsided, but the fact that central banks felt compelled to activate these emergency measures, typically reserved for truly catastrophic scenarios like 2008 and 2020, tells you everything about how close the system came to breaking. Those swap lines still sit there, still active, still ready for daily deployment whenever needed, because the next crisis isn't a question of if, but rather a question of when and whether the coordination that saved the system in March 2023 will still be available when it's needed again.